Hi, everyone. Welcome to Riot's Lunch and Learn series. You found us, the place where we feature all of Riot's partners. My name is Caroline Griffin. I am Riot's Director of Operations, and I'm super excited to have Sean Valle with Fourscore Business Law here with us today. Fourscore has been a long time supporter of Riot, so big shout out to them. Sean is local to the Raleigh area. I know a lot of you are across different sectors, but Fourscore has a nationwide presence as well. So you'll learn more about Sean and Fourscore throughout the presentation. Just a couple of quick reminders before I hand it over to Sean. This is being recorded. It will be posted to Riot's YouTube channel and then shared via the meetup group where you registered for this event. If you have any questions throughout the presentation, please put those in the chat box. Sean has agreed to make this a pretty interactive session, so I will be reading those questions aloud for Sean throughout the presentation. But if you feel more comfortable, you can, of course, wait till the end and unmute yourself and ask questions directly to Sean. But during the presentation, please do keep yourself muted out of respect for the other attendees. But again, thank you for joining us. I will now hand it over to Sean. Sean, thanks for being with us today.
Yeah, thanks so much for having me. I'm excited to be back with Riot, and it's nice to connect with y'all. As was just said, please feel free to put comments or questions in the chat as we go, and we'll be kind of addressing those as we go. So this is really not intended to be a lecture at all. I just really want to make this as interactive as possible. So feel free to jump in with any questions as specific or general as you'd like. My name is Sean Valle, and I work at Fourscore Business Law. Most of us are in the Raleigh area physically, and throughout the triangle. We also have some team members who are kind of scattered around and are working on building a pretty sizable presence out in the Silicon Valley area right now as well. But we work with clients who are based all throughout the country and clients in different parts of the world as well. Primarily working with LLCs and corporations, and in a lot of ways, clients that are doing some kind of growth. So, the word startup is very broad, but we're working with clients of all different sizes who are undergoing some different stage of growth. So we have this internal motto and belief that ideas deserve opportunity, and that's really what guides everything we do. And we operate around these core principles of trying to simplify the complex, meeting expectations around pricing, providing superior work quality, and responding swiftly to client needs. And all this really bundles into us trying to help clients advance and go through those different stages of growth. So like I said, we have clients at all different stages of their life cycles, from just starting out to starting to hire employees or set up advisory boards, to clients raising initial seed rounds or friends and family rounds, to series A, B rounds, all the way up through potential exits, such as a merger or acquisition of some sort. And a lot of our clients we've been working with ever since the early stage of the company. But you can imagine, there's lots of different issues that come into place as you're going through different stages of growth. And we really have the capacity to help with all that. And so we tend to break our practice areas up into three spaces. One is the kind of venture or angel financing, whether that's doing equity financing or debt financings. Our second area is around the mergers and acquisitions, or some kind of exit you might do. Again, whether that's an asset sale to someone or a stock sale. And similarly, some of our clients sometimes get large enough where they then want to start acquiring other companies and growing their own portfolio. And so we'll represent clients on that side as well. And then the third broad category of services we provide are really just outside general counsel services. So when you need help setting up your company, drafting template docs, negotiating documents with potential vendors or suppliers or customers, bringing in employees or contractors, dealing with leases, dealing with IP licensing, and just generally disputing different contracts. Today, I'm going to be talking specifically about startup financing and kind of giving you a brief walkthrough about different considerations and important factors that you want to take into place when you're prepping to do a financing. For a lot of startups, the goal around financing is going to be to get to some kind of preferred stock financing. And we'll talk a little bit more about what that is in a little bit here. I'm going to help you kind of understand a little bit about how to prepare for that, how to go out and talk to investors, and what to think when you're starting to reach that stage. It's always important, even if you're at very early stage of your company, to be thinking about this so that you can start framing your company and addressing issues as you go to help simplify and expedite that process when you get there. Even if you've been through this startup financing before, you'll know that each time is a journey, and so it's always important to kind of refresh on these things as well. There's always two important considerations when you're just thinking about a strategy behind a financing, and these are the questions that should really be guiding how you're approaching all of the other stuff we're going to talk about here. First, what's your end game? So where do you want to get with your company? And second, do you need outside capital to get there? And so the answers to these are not always super clear cut. And it's really, particularly for the first question here, is really just a matter of what you and your other co-founders, your other team, your other existing investors, if you have them, are envisioning for the company. Endgame doesn't always have to mean some kind of exit. It could mean that you want to position the company to reach certain milestones and you want to continue to develop the company as a revenue generating platform after a certain number of years. It could be doing some kind of merger acquisition or IPO or other kind of exit, but it's really important to have these things in mind because it'll influence what kind of financing direction you go down to get there. And depending on what the answer to the first question is, you might not always need outside capital to get there. Or you might only need certain types of outside capital or certain levels of outside capital. And it's really important to think about these questions and just have them floating in the back of your mind as you're thinking about how you want to grow your company. So you always want to start with why. It's always really important. Raising money is important because it helps you do whatever your goal is for the company faster, or it can. It helps validate your idea in the marketplace. And it helps with the survival of your company. So you hear a lot about different startups who are raising big amounts of money. They might be doing it, having multiple financing rounds over the course of a couple of years. They might have extended periods of time between financings. And a lot of the time, the reason that you're doing certain types of financings and how frequently you're raising money comes down to these three considerations. How fast you want to grow, how fast you want to try to reach your different goals, how quickly can you validate your company's mission and direction, and can investor funding help validate that further so you can continue to grow, and do you need this funding for survival? There's a lot of different avenues for financings, and we're not going to be able to touch on all of these today, and we're not going to be able to dive into them in specifics, but it's worth thinking about all the different places that you can get funding and how the motivators for those sources of funding are different for each of these types. Because again, this will help you think about how you're going to approach those potential contributors of capital, how you're going to strategize and structure that financing deal, and who would be potential valuable strategic partners for you. Hear a lot about friends and family rounds as an early stage round. It's great if you're fortunate to know some folks who have a lot of capital and are willing to give that to you. A lot of times friends and family are motivated by helping you and getting some kind of capital return. If you do crowdfunding, or if you're heard about or read about crowdfunding, again, a lot of the benefits here is really for people getting an economic return and to have the opportunity to invest. We won't go a whole lot into securities laws here, but these help inform a lot of decisions you're going to make around financings. And crowdfunding is particularly valuable for smaller investors because it gives them the opportunity to actually invest in companies like this where they otherwise can't due to securities laws. You might be considered joining an accelerator program like Riot, and some accelerator programs will help provide capital or take equity in your company in exchange for capital or your participation in the program. Accelerator programs, from an investment standpoint, are going to be motivated by having a return, building out the portfolio, being able to help their communities and be able to build that kind of strong network of foundations amongst all the portfolio companies they have. Angel investors are going to primarily be motivated by having a return on their investment. A lot of them like to have certain social impacts and targeted impacts based on the industry that the companies are operating in. And there is always a benefit amongst angel investors of just kind of having bragging rights of helping out companies that are affiliated with their institutions or organization, however the angel group is structured. Venture capital groups, the groups that are primarily going to be leading deals like Series C financings, are going to be primarily and often almost exclusively motivated by a return. Banks, similarly, if you're going to go to a bank for a loan or some kind of other investment, are going to be motivated by a return. Government grants, loans, things like that are going to be primarily targeted towards having a certain economic impact. And if you're having to turn into your savings or something like that, the primary motivation there is going to be really to try to conserve the amount of equity that you have in the company, not give that up to external sources. And if you're just really need to do that and desperate to do that in order to be able to get your company to survive and grow the way you need. So again, it's important to think about these and understand when you're approaching a different group, how you might want to frame that conversation, frame what you're asking for, and adjust your expectations when you're having a conversation with them.
Sean, we have two questions here from Arlen. The first one is, are inflection points really the best time to raise money?
Yeah, so it's a great question. It's very unique to each company, obviously. A lot of times you want to raise funds, but I'll say that it depends first on what type of finance you're going to do, and we'll kind of break down a couple of those categories here in just a second. But if you're doing a financing that's going to involve you surrendering equity or other ownership in the company, a lot of times you don't want to do that necessarily until you need to in order to advance to some certain stage of growth, or you need it to survive. And so a lot of times that tends to happen around inflection points, simply because that's when it becomes critical to bring in those funds and advance. And in those instances, you'd be willing to actually give up some ownership in your company. The other thought around this is that when you reach these inflection points, one of the reasons you might want to be bringing in funds at that point is that some kind of new stage of growth you're going in might deplete your existing resources. And so having additional resources to back that up would help you advance to that next stage. You're always welcome, and for your company can raise funds at other points, which might then just provide you a cushion, or it might help again at some point inform how you're going to grow the company in the future. But particularly if you're going to be granting equity, it's not always in your best interest to just be giving out equity in exchange for funds if you don't necessarily need those funds.
Thanks, Sean. That's super helpful. And the second one, you touched on this a little bit, but what are the best ways to bootstrap your company?
Yeah, so lots of different ways to do this, and I'll just kind of preface this by saying that having a solid understanding of your own kind of personal financial situation as a founder, as well as having conversations with your other founding team about everyone's kind of capital situations and what everyone can or can't contribute, is really important to have up front. Because if you're fortunate enough to be able to have some savings or other funds set aside where you can contribute some capital yourself, that's always the best option at the early stages, just because you preserve equity, you're kind of investing in yourself, and you can structure those initial investments for yourself where you would get that money back in the future as kind of like a debt to yourself. And you're communicating to other potential investors in the future that you believe in this idea enough to put your own capital in it. So I always recommend that, again, if you're fortunate enough to be able to have funds you can put into your startup, best way to bootstrap is to try to do some of this yourself. Again, depending on your level of risk and what you can do, that could involve taking out like a personal loan, taking out a loan in the name of the company where you're going to probably be asked to sign a personal guarantee. But it's always about really understanding your own kind of personal situation. If you can't do that, then the next best thing is, again, if you're fortunate enough to know other people who are wealthy and might potentially be able to invest money in your company, always great to do that, because they'll usually be more friendly and favorable to you than going out to investors you don't know. And they'll likely be willing to invest in a company before you've demonstrated value in the market. So those are the two kind of very early stage things that we recommend from the early stage, just to be able to get you up and going and to demonstrate that you have a market. A lot of companies, if you don't have funds yourself, you can contribute. If you don't necessarily know external people who are willing to put funds in or have funds available to put in at the early stage, those companies will turn to like a debt source of debt, like from a bank or something like that. Again, you have to understand though that a lot of times, particularly early stage of a company, a bank is going to want a lot more information than you might already have, such like around a very detailed business plan or something like that. And two, they're often going to require that you as the individual, or each of you individually as your founding team, personally guarantee repayment of that debt. So you're taking on a lot of risk yourself. But as much risk as you can bear yourself, the better, because you retain as much ownership in the company as possible. So that's kind of a good transition here to talk about 4 of the kind of common financing types. If you can find grants that are targeted towards your industry, the ownership of your company, like there are grants available for companies that are primarily owned by minority business owners or female business owners. If you can find grants that are targeted towards you that you qualify for, that's great. They're non-dilutive, meaning you don't have to give up equity for it. You don't have to take that risk that I was just talking about yourself. And you get some funds, at least to launch you to a stage where you can demonstrate value in the market. So if you can find grants and get access to funds that way, that's great. Convertible securities are also a very common financing type, particularly when you're starting to bring in angel investors or early stage friends and family, folks like that. And there's 2 of the most common of convertibles are either a convertible note or a safe agreement. And you might have heard about both of those. I'm not going to go into too much detail about them here, but the idea of both of those is that someone is putting in funds now, and in exchange for putting in funds now, they have a right to convert that amount that they're putting in now into stock if you sell it in the future to preferred investors at some kind of preferential terms. Again, a common goal for a lot of startups at some point is to do an actual equity financing, where you either might sell common stock, which is just kind of the standard stock that you as a founder and other just basic stockholders would have in the company, or preferred stock, which is a very robust, complex process that involves creating a whole new category of stocks with certain preferential treatment that the investors would get. And usually you're not going to worry about giving preferred stock out and going through the whole process of creating that until an investor is putting in a very sizable amount of funds. And then lastly, like I've talked about a couple of times here, is debt. You can either try to find a conventional loan from a bank or another source, a line of credit. You could have something like we talked about, the convertible notes, or you can just try to structure some other standard note agreement or note debt with investors that wouldn't actually ever convert into equity, but you'd still repay it.
Sean, 2 questions here. The first one is, what would the structure and terms of a convertible look like? Specifically, they would love to hear some example terms.
Yeah, sure. And so I'll break these up a little bit, because again, the convertible notes and safes at their core function with the same idea that someone's giving money now and that might convert in the future, but they operate a little bit differently. So a convertible note, for example, the idea is that let's say someone is going to invest $100,000 in your company. They would put that $100,000 in the company and in return receive a note from you that says, by a certain maturity date, you're going to repay them that amount plus interest. But if you do an equity financing, such as selling preferred stock, before that maturity date happens, then they will get to convert that $100,000 they put in plus the interest into whatever stock you're selling at that point. And that amount that they put in plus interest would go towards purchasing that stock, but the price that they are purchasing that stock at is often set at a reduced amount from what the investors in the actual stock financing are paying. And there's two ways that that's usually reduced. One is called a discount, where you're just saying whatever those future investors pay, I'm going to give you a 20% discount on that price per share. The other thing is where you set an actual cap on the value of your company. And if that future financing is based on a value of your company that's higher than that, well, then the convertible note investors get the benefit of just using the lower valuation. And so that would result in them essentially getting more shares than if they had just come in at the actual preferred stock financing when you do it down the road. Safes are very similar to that, except for two primary distinctions. One, safes don't accrue interest. So when they do convert, it's only on the amount the person actually put in. They don't have interest. And safes don't have a maturity date, so there's no obligation to repay them. So if you took in $100,000 in a safe from and gave an investor a safe for that $100,000, and then you never raised funds, well, they would just continue to hold that safe forever. So from a company's perspective, safes are great because they don't accrue interest and you don't have an obligation to repay them. But that means that a lot of times anyone who's an experienced or sophisticated investor might prefer convertible note. There's other subtle differences between these that can change that answer, but might prefer having a convertible note because they want to accrue interest and they want to know they'll get paid back if you don't actually raise funds.
Thanks, Sean. The second question here is from Tom. He's asking if you could spend a little bit more time talking about the difference between preferred and common stock.
Sure. Yeah. So let's say you've set up your corporation already and you're setting up as a C corp, and let's say you have your founding team and you're all getting stock. The stock that you are all getting in the vast majority of situations is just called common stock. It's just one general kind of class of stock. And what it means is that everyone who owns that stock has equivalent rights to each other in terms of economic rights or voting rights. If you were to sell the company or make distributions out or give dividends or anything like that, it's going to be given out to all the holders of common stock at just their pro rata percentage of however much of the common stock they own. So that's just how standard common stock works. The idea of preferred stock, and just given its name, is that it's getting preferential rights to the common stock. And a lot of times, I mentioned earlier, it's a big undertaking to issue preferred stock because there's just a lot of different moving pieces around that preferred stock. But a couple of the major differences and a couple of the major preferred rights that those preferred stockholders get is that in most situations, they'll be if you sell the company or liquidate the company in any way, they would be the first ones to get any kind of payment from the proceeds of that. And so they would get paid out based on whatever metrics you outline in your documents. And then anything left over after they've gotten their share would be distributed out amongst the common stockholders. I mean, there's a lot of different subtleties and ways that can change based on the unique rights those preferred stockholders want, but that's the idea. They're going to get preferred rights in terms of the economic, often we call it a waterfall of any sort of payments that come out from a liquidation. Similarly, they might get rights to certain dividends every year that the common stock doesn't have. They might also have a right to appoint someone to the board specifically. So you have like a preferred stock director, and that person would specifically be voted into office by the preferred stockholders and not the common stockholders. They might also have other voting rights, or they might have certain veto rights over certain company actions, such as selling the company. You need to go get the preferred stockholders' consent before you could sell the company. So there's a whole bunch of stuff that gets baked into that. And when you go prepare for a round where you're going to sell preferred stock, you would negotiate that on a term sheet back and forth with an investor to decide what all those terms are going to be before you do that. All right, and when you're thinking about approaching any investors, also really important to think about what they're looking for. And again, what they're looking for will slightly depend on their motivations that we talked about towards the beginning. But pretty much all investors, particularly large investors that are going to come in and think of themselves as part of your team, are really looking for a strong team. So like you, your founders, your other executives are strong. You have experience in your field, you have experience with business. You're dedicated, you work well together, and they believe that you as a team can advance the goal and the mission of your company. They're looking for people who are in executive roles to be coachable. Again, for large investors, particularly ones who might be considering you to be a strategic partner or come in and think of themselves as part of your team, want to be able to provide their expertise and know that you'll receive that advice and expertise that they share to help grow the business better. They're also looking for a good idea, which to some extent goes without saying, but they want to be able to believe in their idea and believe that it's going to have success in the market. So a lot of times groups like venture capitalists, angel groups will want an actual kind of tangible demonstration that your idea is good in the sense that it has a place in the market before they're willing to invest. But that's not always true. Sometimes investors have enough confidence in the idea based on their own values, beliefs, interests, that they'll believe it's a good idea simply from that. And they want to a lot of times know that they can add value. And this really depends again on what type of role that investor is envisioning taking. A lot of people will come in just kind of passively with just the hopes of getting an economic return or supporting you. But a lot of times investors, particularly larger investors, want to know that they can add value to what you're doing and help advance what you're working on. It's also very important for you to think about what you want from an investor. And this is specific to every company, every set of founders. Not every investor is the right match for you, and that's okay. You want to recognize that this is an equal relationship. So you don't need to accept money from anyone just because they're willing to give it to you. If it's really important to find an investor that you actually want to bring in as an investor, particularly if you're giving things like preferred stock and they're going to have significant rights or involvement in your company. A big thing to look for an investor is that they can fill holes in your expertise. If they have a strong portfolio that's similar to your market, if they can provide strategic advisors or board members who are going to be able to help guide you in finding customers, vendors, suppliers, other groups like that, if they can really provide additional value for you beyond just the capital. So you can imagine if you're going to bring in a preferred stock investor and they're getting a board seat, you want that board member who's coming in to be able to actually advance your company. You don't want them to just sit there and basically just be listening to what you're doing with your company. You want them to provide some actual substantive value. You want to know that they have a strong track record with other companies that they work with, and they can connect you to other capital and strategic relationships. And to this extent, as much as possible, it's great to try to connect with other companies who have worked with those investors to try to understand what the relationship is actually like with that investor. And just generally, you want to make sure it's a good culture fit. Again, that's more of that like feeling, with the kind of culture vibe, relationship you're trying to establish amongst your team, your founders, your broader community at your company. Does that investor fit in, and are they going to help promote and shape that the way you want? There's also lots of different things you can do to help increase your chances of getting a successful fundraise. One thing that's really important and a lot of companies don't always think about is having very clear, defined metrics for success. So if you go in and say, this is our vision, this is what we want to do, this is our, this is where our company wants to go, but you don't have tangible milestones for that, it's hard for an investor to see how they're going to actually know that you've been successful or not, and that you're going to be able to provide a return for them. You also want to make sure that you're doing your homework on the investor. Again, understanding things about their culture, about their portfolio, about what they want, what they look for, who their team is, who the specific people that you're going to talk to are. Because if you go into a conversation not knowing any of those things, they won't necessarily get the impression that you are going to respect or appreciate their investment. But if you can go in and have a deeper substantive connection and conversation with them, that already sets you up to be seen as a valuable potential partner. You want to make sure you have all your books and records in order. Nothing is more frustrating than when you're going into a big financing and you've got all this kind of messy records, whether that's your legal docs, your organizational work, your financial work. And it's just a mess. And an investor comes in and sees that you don't, and gets the impression that you don't necessarily know how to properly keep track of and manage all these things and take those things seriously. You want to be realistic. So if you go in, your company's only been around for 2 months and you're trying to value your company at $20 million, unless you can justify that, an investor is probably not going to take that seriously, and they might they might consider you as being unrealistic in what you're able to actually provide to them. You also want to be realistic in what you're asking the investors for. Again, if someone's going to be putting in millions of dollars into your company, they're going to want some significant rights. That's a lot of contribution. They're going to want to protect that investment. If an investor is coming in really early and you're not willing to give them stock, and you don't give them very preferential rights on a safe, for example, so they know they're not going to get any sort of interest or guarantee of return on payment, you have to understand that means they're taking on a lot of risk. So you just want to be realistic about the capital people are putting in. And if you can, it's great to kind of put together a term sheet, or at least know what you actually want from them, so you have a very targeted, specific ask. Depending on where you are in the country, the kind of culture shifts based on who provides the term sheet, either the investor or the company. But at the very least, you want to actually know what you're willing to offer and what you want from them. So if you go in and they ask how much you're looking for in funding and you don't really know the answer, that doesn't look great. But if you can go in with a specific number that you want to raise in a round, and a couple of different things about what you're comfortable giving, that will help them understand that you're taking this seriously and you know what your company needs. Just a little bit more details here. If you get to the point where you're ready to actually do an investor pitch, make sure you know your basics, all your team, your problem, your market. You can demonstrate all these things in clear, direct ways, so you can understand, so you can articulate to the investor what the value is that you're trying to provide and to solve that problem and fit that market. You want to know the investor and their interests. And so, for example, if you're not doing B2B at all, and you go in talking to an investor who's regularly investing in B2B, even if they're interested in your company, they're going to recognize that you're not necessarily prepared, and therefore you might not necessarily know what you're looking for. Make sure you practice. There's a lot of different resources through groups like Riot, through co-working spaces, through just startup networking groups, where you can go practice your pitches, either to experienced investors, to just other people in the group, to lawyers, accountants, and getting that feedback from people can help you really hone in on what's important to communicate, and that really demonstrate the value that you're looking for. Again, know what you're asking for and try to keep it short and simple. Recognize that a lot of investors are getting a lot of different pitches, and so they really want to just hear quickly what's the value you're providing, what's the problem you're solving, how do you demonstrate that you're actually going to be able to solve it, and how would they actually get a return on their money.
Sean, question here from Greg. If the intent is to have future investors, accredited and institutional, is there an advantage to start the company as an LLC for simplicity and cost before getting investors, and then convert the company to a C Corp?
Yeah, that's a great question. And this is kind of the lawyerly response I've given a couple of times. It really depends on the specific situation. A lot of times, if you know you're going to go down the path where you're going to try to pitch to investors, it is cleanest, easiest, most cost effective to just start out as a corp. And there's all kinds of different tax situations that could go into making that decision from your own individual personal standpoint as opposed to the company standpoint, such as how you're going to compensate yourself as a founder or employee of the company, what other kind of tax responsibilities you have. And so I always recommend people have a conversation with an accountant to understand how that will impact your own personal finances as founders. But a lot of times, the easiest, cleanest way is to start out as a corp, get all your docs structured and together as a corp, and then you can just grow from there, having everything clean and organized. That being said, you can absolutely start as an LLC if it makes the most sense to do that. And then at a future point, convert into a corporation. That's a standard process that all Secretary of States or equivalent offices in the states where you might be setting up allow you to do. Similarly, you could start as an LLC in one state and then convert into a Delaware corp later or something. But the vast majority of larger institutional investors are going to expect to invest in a corporation. And a lot of the kind of standard financing structures are built around the way that corporations are taxed and managed. So that process becomes a lot easier. So general short answer is I prefer people just kind of, if you know you're going down that path or you're going to raise from institutional investors, start out as a corp, keep everything that way from the start so you can have clean, organized books. If for whatever reason it makes significant financial sense to start as an LLC, totally fine. And then you can convert into a corporation later, just understanding that you'll kind of have that added cost and complexity down that road. One other last piece on that I want to say is that if you're planning to offer incentive equity to contractors or employees, it is so much easier to do that as a corporation than an LLC. Again, a lot of that boils down to just the way that they're taxed. But there are standard mechanisms for granting stock options or other incentive equity through corporations that just don't translate as easily with LLCs. It's not to say you can't do it through an LLC. It's just a little bit more complicated.
Thanks, Sean.
Yeah. A lot of times, one of the most frustrating parts of trying to pitch and have conversations about financing is just repeatedly being faced with a no, particularly if you're an early stage company. And so it's worth kind of thinking through what you can do to change that answer. And as an aside here, it's perfectly acceptable that if people are telling you no, to ask them why, right? So if an investor is willing to talk to you, but then they aren't willing to put in actually commit to funding, it is absolutely acceptable for you to try to get some feedback from them as to why. And a lot of times, particularly at the early stage, that might just come down to demonstrating the market and demonstrating your company's ability to solve a need. Because again, particularly with institutional investors, they want you to have been able to demonstrate that already, which puts you into kind of a funky situation where you need money to be able to develop your initial product and put it in the market, but no one's willing to give you money until you've developed your product and put it in the market. And so you really have to just get creative sometimes around being able to find and gather that initial funding to be able to get out at least an alpha version of your product and get at least a couple customers committed, signed up, paying you to some alpha beta version. So you can at least demonstrate the market in some way, and then focus on that ability to demonstrate the market so that investors understand the value. And that's what's really going to help you de-risk this opportunity. Because again, if people are putting in a lot of money, risk is really the main consideration they have here. They don't want to put in funds for something that might just shut down. And so if you can do anything you can, like by demonstrating the market, building a strong team, giving better terms to de-risk the opportunity for the investors, the more likely you'll have to have funding. You can also do things like being part of Riot or joining other accelerator or similar programs that will help you build a strong team and get access to resources, potential customers, contacts, partners who can help you build out your product in those early stages without having to go out and get significant capital. And then the last thing is that you can try to approach this from building a real business, right? Like a startup. The startup culture is one where you go out, and when you need funding, you try to raise funds. What if you think about the way a lot of small businesses and other businesses operate, they're trying to focus on getting enough money in to be able to put out a product, but then the model shifts to funding the business through profits, which is obviously a much slower, much more risky model for founders and companies. But it just goes to what kind of value you want. And if you're getting no's a lot, you can just try to shift and focus instead on trying to build a slower business based on profits and profitability, as opposed to just trying to raise funds every time your bank account's running low. We at Fourscore put together a bunch of resources. We put it together a lot. We spent a lot of time putting together an extensive resource page on our website. And so I strongly recommend y'all look at our resources on our website. We have a full new business blueprint that walks you through a bunch of different steps of setting up an early stage company. We have some white papers about specific areas. We have blog articles about all kinds of different topics, as well as some really short videos you can just watch that help explain some of these topics. And I really, really recommend turning to that resource whenever you have questions, because there's a lot of really valuable stuff in there. And if you have any questions about those things, you're always welcome to reach out to anyone at Fourscore or me specifically. I put my email here on this last slide, as well as my LinkedIn handle. Please feel free to reach out with any kind of questions. If you are looking for legal help or anything like that, you're absolutely welcome to reach out to us. And we for anytime we have a first call with us, we'll be able to address kind of what needs you have, and that calls on us. So you don't have to hesitate to reach out to kind of get some general guidance and understanding of where you might be able to help your company grow more.
Fantastic. Thanks, Sean. And just again, can't recommend Fourscore Business Law enough. They have worked with dozens of our accelerator program participants, and high recommendations all around. I see a question in here, Sean, from Rachel. Do you have any tax accountants you can recommend? Rachel's working with a small firm, but our business is a little too complex for them, and they need help finding someone to help them intelligently position and avoid tax issues in the future.
Yeah. It's a very straightforward answer. Yes, absolutely. We've got a strong network of folks who are very familiar with working with startups as they grow, and have resources to be able to help you as you're growing throughout the different stages of your company. So I'd recommend just shoot me an email, and I can send you a couple different recommendations that I have, and happy to connect you to any of those.
Thanks, Sean. We'll leave it open for just a couple more minutes. If you have any questions, please feel free to unmute yourself. Fourscore will be doing several more virtual lunch and learns throughout the year on different topics, so stay tuned, keep an eye out for that. Thank you, Sean, for providing your contact information. Again, please don't hesitate to reach out to Sean with any questions you may have. All right, it looks like we got all the questions answered throughout the presentation. So once again, thank you for joining us, Sean. Thanks for being here, y'all. This was recorded, so you can go back and reference it. We'll post it to the meetup group where you registered for this event. Thank you so much.
Yeah, thank you so much for having me. Have a good one, everyone.
Thank you.
Take care, y'all. Bye.